Now see this question. Sushma Limited purchased a plant on 1st April 2015 for rupees 2,40,000. It bought another plant on 1st July 2016 for rupees 1,60,000. On 1st January 2018, plant bought on 1st April 15 was sold for rupees 1,60,000 and a fresh plant was purchased on the same date. Now, this given payment of this plant will be made as under. So this means that see you are purchasing this new plant on 1st April 2000 for 1st January 2018, and on that date you are paying only 40,000. Rest of the payment you are making in 2 years in two other installments. That means you are purchasing this machinery, this plant on credit also. So you have to calculate the purchase amount. Payment made in 1920 include interest of rupees 8,000 and 4,000. So this include interest of 8,000, this include interest of 4,000. So interest will not become part of cost because interest has been paid after the machinery has been put to use. If the machinery would not have been used, then this interest can become the part of the cost of the machinery. So we will eliminate the interest part and then we will calculate the cost of the machinery. Depreciation 10% per annum on diminishing balance method. Show the plant account for 3 years. So we have to prepare the plant account. The date is 2015, April 1. To bank account. And the amount is 2,40,000. It bought another plant on 1st July 16. So this is not a transaction for 15-16. It will not be recorded in this year. So in this year only one transaction is there. So we will charge a depreciation on March 31st. By depreciation account. Now the rate of the depreciation is 10% and we have to charge a depreciation for 1 year. So it will be 24,000 by balance carried down. Total will be 2,40,000. Balance will be 2,16,000. Now in next year, April 1 to balance brought down 2,16,000. Now first check the transactions done in 1617. So on 1st July 16, you have purchased another plant for 1,60,000. To bank account 1,60,000. Then on 1st January 18, so 1st January 18 will be in next financial year. So this transaction will be recorded in that year only. Yes, please. So, okay. So we will charge the depreciation in 2017, March 31st. And this time, because we have two plants, so we will be charging depreciation on two plants separately. We will prepare a working note. Depreciation on plant purchased on April 1, 2015. So the cost was 2,40,000 multiplied by 10 upon 100. It will be 24,000. Then the written down value is 2,16,000 in the next year. 2,16,000 multiplied by 10 upon 100. So it will be 21,600. The new plant has been purchased. Depreciation on plant purchased on July 1, 2016. Cost is 1,60,000. Rate of depreciation is 10%. Time we have to count from July 1 to March 31st. We have used this machine. So July 1 to March 31st, it will be 9 months. 9 upon 12. If we will simplify it, it will become 16,000 into 3 upon 4, and that will be equal to 12,000. So here the depreciation will be 21,600, and second depreciation will be 12,000. So we will total both amounts. 33,600. Now we will calculate the balances. Separately. So first machine balance will be 2,16,000 minus 21,600. So 2 lakh, 1,95,000, 1,94,400. It will be 1,94,400. Then the second machine balance will be 1,60,000 minus 12,000. So it will be 1,48,000. We will sum up. So it will be 400 first. Then 8 4 12, 10 4 14, 3. Sorry. 3,42,400. Now we can total both the sides. This total will be 3,76,000, 345, 375, 3,76,000. Yes, it should be equal. Then in 2017, April 1st, we will write down the opening balances. To balance brought down, and these closing balances will become automatically the closing balances, opening balances. Now see the transaction done in 2017-18. So on 1st January 18, you have bought a plant, you have sold out a plant for rupees 1,60,000. So January 1, by bank account 1,60,000, and because this plant was purchased on April 1st, 2015, so this is the first plant, so we will charge depreciation on that. By depreciation account. Now the written down value of this plant is 1,94,400. Multiplied by 10 upon 100, multiplied by, we have to count the time. So April 1 to January 1, it will be 9 months. So it will be 19,440 multiplied by 3 upon 4. It will become 4 4 the 16, 34, 4 8 is a 32, 24, 4 C 24, 4 8 C 0 multiplied by 3. So 12,000, then 2,400. 12,000 plus 2,400 plus 180. So 14,580. 14,580. 14,580. So now we can calculate the profit and loss. For that, we can also make the working note. Third working note, profit or loss on sale of plant WDV is on April 1, 2017 is equal to 1,94,400 less depreciation is equal to 14,580. So WDV as on January 1, 2018, it will be 1,94,400 minus 14,580, 1,79,820. Now we have got the WDV. Share value is 1,60,000. So finally, the loss on sale of will be, we should write here loss on sale. Loss is equal to 19,820. So by statement of profit and loss is equal to 19,820 820. So this way the first plant account has been settled. Now we have this one plant and we have purchased one more plant. So now if I subtract interest element from here, that means it will be 40,000. I am paying as principal amount. From it, this is the principal amount I am paying. So 40,000 plus 40,000 plus 40,000. So the cost of the machinery will be purchased on January 1, 2018 is equal to 40,000 plus 48,000 plus 44,000 minus 8,000 interest minus 4,000 as interest. So this will come 1,20,000. And out of this 1,20,000, we are making payment of 40,000 on the date of purchase. Rest 80,000 we will be purchasing later on. So now the entry will be here. January 1 to bank account 40,000. Then to, we can use the word vendors, creditors for plant 80,000. This will be the entry because we don't know the name of the seller. Now on March 31st, we will be charging the depreciation. Again, two plants are there now. So first plant depreciation. Okay. So we will calculate the depreciation on this machine. Now its written down value is 1,48,000. And we have to charge complete 1 year depreciation on that. Yes. So it will be is equal to 14,800. Then second cost is 1,20,000. Depreciation is equal to 1,20,000 multiplied by 10 upon 100 multiplied by 3 upon 12. January, February, and March. So it will be 12,000 multiplied by 1 upon 4 is equal to 3,000. 17,800. Now we can calculate the closing balances. March 31 by balance carried down. First, so 1,48,000 minus 14,800. It will be 1,44, 1,34, 1,33,200. 1,33,200. Then second, 1,20,000 minus 3,000, 1,17,000. So 140, 150,000, 200, 2,50,000, 200. Now we can total both the sides. So it will be 342 plus 20, 362 plus 1 lakh. So 4,62,400. 4,62,400. Now coming on this side, so this total is itself 1,94,400. Then 195, 200, 2 lakh 2,200, 2 lakh 12, 2 lakh 62,400. Yes, 4 lakh 62,400. It is also coming equal. Then we can write the opening balances in the next year, 2018, April 1, to balance brought down, and these closing balances will become the opening balance. So I hope it is clear.